Thank you for joining us. Our webinar this month is on estimated or sometimes called quarterly taxes. And there's a few things we commonly hear from clients and prospects as we review their tax return. And the big one is, why do I see a penalty on my tax return? You may not have seen that in the past, or it just might now be big enough of a number that it's catching your attention. And one reason this is coming up a lot more recently is because how the IRS calculates underpayment penalties is based on interest rates. And so, as you know, we've talked about this in many different aspects of financial planning. Interest rates have gone up recently, and that means that the IRS is charging higher interest on any taxes that it sees that you've underpaid. And so a few years ago, this interest rate was much lower, 3%, for example. This chart here is showing the quarterly interest rates that the IRS charges underpayment penalties. Most recently has been up to 8%. And so if you've been a little bit behind on your tax withholdings or the taxes that you've paid, maybe in the past you were just paying 3%, now it's 8 or it just dropped down to 7. And now you're starting to see the impacts of that interest rate a little bit. One caveat I should say here, we're going to talk a lot about estimated taxes on the federal side, but these very similar calculations happen on the state side also. And just there's a lot more variability there, of course, and on state tax rules, but know that the same idea applies for state taxes as well. And again, just to put that chart in kind of a little bit of a different number here, if you've seen increased tax penalties, you are not alone. This is a chart from an article in the Wall Street Journal, but the data is just from the IRS. And this shows the amount of money that Americans are paying in estimated tax penalties. And again, as those interest rates increase, you've seen here 2023, a really big jump in tax penalties. Americans paid about $7 billion in underpayment penalties, big jump from the last few years. And so, why are these estimated taxes needed in the first place? Again, if you underpay your taxes, the IRS is going to impose some kind of penalty on you. And if your income is steady, so this is your general worker, W-2 worker, retirees who get just a regular monthly IRA withdrawal, pensioners, Social Security people, for example, typically you can just easily withhold taxes from this type of an income. You still need to calculate how much you need to withhold, of course, but once you do that, your pay is steady, your IRA withdrawals are steady, and you can kind of set that and forget it. But taxes are not withheld from some types of income. And for those that have substantial assets or assets in these types of accounts, substantial interest or self-employment income, for example, then this becomes much harder to plan around. You can't withhold as regularly as you'd like, and you have to start sending in separate payments. And so generally, this is going to be if you have a lot of capital gains, dividends, or interest income, those in kind of the gig economy or just self-employment income in general, you'll have to submit these quarterly payments. Rental income can be another one. There can be lots of other sources here. I just tried to list a few that we see as more common. And then besides the type of income, there's scenarios that might trigger the need for you to start sending in these estimated taxes as well. A big one's going to be Roth conversions or just any kind of large irregular IRA withdrawals. So you need a big withdrawal to make a car payment, make the down payment on a retirement home. If that comes from an IRA, it's likely causing some other tax issues by causing you to jump up into a higher tax bracket, something along the lines of causing you to have to pay a little bit extra in taxes. Large capital gains are another one. So not only just regular capital gains you get from your investments, but hey, we needed to sell $50,000 of a highly appreciated stock. That causes a big jump in capital gains from what you're used to and may require that you need to put in some estimated payments here. Again, higher yields, we talked about higher interest rates. That's also meant higher yields from, things like your bond funds or CDs, even high yield savings accounts that if you have a lot of money in those types of investments is now starting to give you a lot of income that you haven't been withholding taxes on. Social Security can be another one. It's very easy to withhold taxes on Social Security, but it may not be done by default. So when you just start Social Security benefits, you might have this jump in income that you're not withholding benefits on. And if you're really high income, Social Security only gives you a few different options for withholding amounts. And so if you are in a higher tax bracket, you may just not be able to withhold enough on your Social Security benefits. And of course, again, lots of other scenarios that may cause your financial situation to change a lot and require you to start uh, paying in some extra. And so the big question, of course, is how do you calculate what you need to pay in? The IRS has a couple tools available. I put a link up here for what they call their tax withholding estimator, and this is primarily designed for those that are working like a W-2 income, but it can be a way to put in all of your information and be able to see what an estimate for your total year tax bill will be. Of course, it can get pretty complicated trying to do this on your own. I'm including a couple images from our tax reports that we prepare if we're reviewing a tax return. And you can figure out how much of your income's taxed at each one of the income tax brackets, where exactly long-term capital gains or qualified dividends are falling. So which rate are those being taxed at? And then besides that, what tax credits and deductions and surcharges are you being subject to? What are you itemizing or getting standard deduction? Are your capital gains short-term or long-term? Are your dividends qualified or non-qualified? This can get really complicated to figure out. And to some extent, the IRS understands this. And so they've made a couple blanket rules that if you meet these requirements, you may be able to avoid an underpayment penalty. And so the first one is just if you owe less than $1,000 or not. The IRS is not going to start nitpicking if you underpaid by $20. And so they put this kind of $1,000 limit out there. The bigger one, the one that comes up most often, is the second bullet point, which is a couple different requirements. One, you must have either paid at least 90% of the tax bill for the current year, or you paid at least 100% of the tax from the prior year. You paid that this year. In other words, you paid the taxes that you owed last year. You continued that on. That 100% rule jumps up if you are higher income. So if your AGI is more than 150,000, the IRS wants you to pay 110% of prior year taxes. And so the second rule here is what's known as safe harbor. And so again, this is just that rule there, either 90% of the current year or 100 or 110% of the prior year. If you've paid that, you are meeting what's called safe harbor. And this is why your CPA likely asks you to make those estimated tax payments. They're getting you up to the safe harbor amount. What they're probably telling you to do is either 100% or 110% of that prior year tax bill. If you pay that regularly through estimated taxes, that can get you off the hook. And so sometimes it seems a little bit too conservative to have your CPA to make these quarterly payments your CPA is asking you for. But the reason they're doing that is to get them off the hook of you having penalties later on. They're sometimes it's too much, but they're giving you a number that should help you avoid those underpayment penalties. However, where this gets confusing is that just paying in that annual safe harbor amount is not always enough. And that's because actually what the IRS is looking at is your income and your withholdings quarter by quarter. And so, I included a screenshot here of the tax form where you start to calculate this underpayment penalty for you. And what the IRS is going to do is split your tax liability up into quarters. and split your income up into quarters as well and look. And so this can lead to um, some different scenarios where, for example, I put a an example person here, let's say John owes $20,000 in federal taxes for the year. And so he thinks, hey, I'm just going to meet that 90% safe harbor rule. So I'm going to pay in $18,000 over the course of the year, and that's going to prevent me from having to pay any uh, under withholding penalties. And so that 18,000 should be $4,500 per quarter. But what John does is pay it very unevenly. He only pays $500 that first quarter, only pays 1,000 that second, only pays 2,500 that third quarter, and then realizes, oh, I've been underpaying. I'm going to do this big payment in Q4. And although in the scenario John paid $18,000, it was obviously very weighted towards the end. The IRS sees that as basically they've been giving you a loan here for these quarters. You haven't paid in equally through those quarters, and the IRS is going to start tacking on that interest rate or that penalty to those payments. And so, for example, if we assume that 8% interest rate, here's what the IRS might come back to John with and say, you actually didn't meet safe harbor because your quarter one payment underpaid by $4,000. We're charging that 8% interest over a certain period of time, and here's your penalty. And they're going to calculate this penalty quarter by quarter and give you an annual penalty where, again, even though John feels like he submitted his safe harbor amounts, he did not do it regularly quarter by quarter. And how the IRS assumes your income is broken out quarter by quarter is a little interesting and leads to some interesting opportunities here. And so by default, if the IRS sees income that comes in from a 1099 or a W-2, it's going to assume that that income was split evenly quarter by quarter. And so if you have a $100,000 W-2 income or $100,000 from a 1099-R IRA withdrawal, the IRS is going to assume that 25,000 of that came in the first quarter and 25,000 every quarter thereafter. Even if your only income was a $100,000 IRA withdrawal on December 31st, the IRS is going to assume that that came regularly through the year. It also assumes that tax withholdings done through payroll or through IRA withdrawals, withholdings, is also evenly done by quarter. So the IRS is going to see a tax withholding amount on that 1099-R. If they see $10,000 withheld from your IRA, they're just going to automatically calculate that as $2,500 per quarter, even if you only took $10,000 out on the very last day of the year. If you did it through IRA withholding, if you really increase your workplace salary withholding at the very end of the year, the IRS is going to spread it out evenly for you. But estimated payments only count towards the quarter that they were made. And so like that example with John that we saw, if your annual tax bill is $10,000 and you think just by making a $10,000 payment in the fourth quarter of the year, you can satisfy that, probably not correct. The IRS wants to see, if you owed 10,000, they want to see $2,500 paid each quarter. And so that can lead to some interesting scenarios. The really common one we see is for those doing Roth conversions, where you have this big amount of income from an IRA at the very end of the year. And so it's very common to do these Roth conversions in December. The IRS is going to see this income from the Roth conversion on the 1099 and assume it was income that was evenly distributed quarterly. So if you did the $100,000 Roth conversion right at the end of the year, the IRS is going to calculate this that you had 25,000 in income Q1, 25,000 in income every other quarter thereon, and they're going to want to see tax withholdings or estimated payments based on that what they're assuming is quarterly income there. There is a solution to some of these common problems, and that is a special tax form that you can fill out. It's Form 2210 and a specific schedule on there where you can show the IRS how your income varied quarter by quarter. And so in the first quarter, maybe you only made 10,000, second quarter you only made 10,000, third quarter only 10,000, but that fourth quarter you made $100,000, and you can force the IRS to not work on their general assumptions and instead show specifically how your income was split up. And so this is a screenshot of that schedule that you have to fill out. And so while this sounds like an easy fix for those doing Roth conversions, or you just have variable income where you're running into these tax penalties, it's a very complicated form. It effectively requires you to do your tax return 4 times. And so it's very time consuming if you're doing this on your own. And because of that, also, if you have someone else help you with your tax return, they're going to charge you extra to do this, at least $100, probably more for more complex cases. And again, it may not, if you're worried about just a couple $100 underpayment penalty, this form usually just means you're paying your CPA more to get out of that underpayment penalty. And again, this only helps when your income was variable. If you just under withheld during the year because you forgot to make payments, this is not going to help you. This is only going to help you if your income truly was variable. Um, and there are some ways to use the IRS assumptions, though, to your advantage. And so, as we mentioned, withholdings from IRAs that come from 1099-Rs, the IRS is going to assume it was done quarterly, even if it was all done right at the end. And so, for example, let's say you do a big IRA withdrawal, 10,000, withhold $10,000 in taxes on December 31st of the year. This is what your 1099 is going to look like. It does not detail when that withholding came out. The IRS is just going to split this number in box 4 up and apply that quarterly. And this can be a great way to help fix under withholding during the year. And so let's get back to that John example where he knew he had to pay in $18,000 during the year. He did not do it evenly, but if this withholding was done through IRAs instead of estimated payments that he had to make, now the same scenario, John withheld the same amount, but because this $18,000 here is just going to show up on the 1099-R form, the IRS is going to assume it's evenly split out, and it's going to assume he did $4,500 per quarter. And so this can be a nice way to kind of fix some problems if you have room to do some added IRA withdrawals and can withhold taxes this way. This can be a really nice way at the end of the year to kind of clean up some problems if you haven't been making your quarterly payments correctly during the year. And so then the final big question that we get here is, should I withhold taxes from my IRA withdrawals or maybe my W-2 income even, or should I submit estimated payments? And for some, there may be tax benefits to doing estimated payments. And so the big reason here is that IRA withdrawals get taxed as income. And so, again, it's very convenient to pay your taxes through IRA withdrawals, but there's that caveat there that any money that comes out of the IRA is taxed. And so if you want to send in $10,000 for a tax payment, that's actually $10,000 more in income you have. That's going to cause you a little bit bigger of a tax bill. In extreme cases, this could cause you to jump up tax brackets, something like that that you want to be aware of. If you have extra money sitting in a savings account, or even if you have to sell stocks that are in a brokerage account, those have a lower tax liability and ultimately will give you a lower tax bill. And so if you're able to pay estimated payments that way, for a lot of people, it can lower their tax liability. And so just kind of a simple pros and cons here for IRA withholding. The big pros here is that it's simple, it's automatic, there's no need to track these quarterly deadlines, and it can help kind of fix some problems because the IRS is just going to assume that you've withheld evenly throughout the course of the year. But you're going to pay taxes on IRA withholdings, IRA withdrawals that go to taxes. That can cause some problems for some people. And if IRAs are just a small part of your net worth, it just may not be realistic to um, do IRA withholdings for your taxes if you have a big, brokerage account, big capital gains, big dividends, big interest. It just might not be feasible, and you might have to do these estimated payments. And so for these estimated payments, so this is if you are not withholding from your paycheck or your IRA, how do you do it? The IRS makes it very easy. They like to get your money. So irs.gov/payments, you're going to see this page, and you can choose to either pay directly from a bank account. So here you're going to enter a bank account, a routing number, and pay that way. You can also pay through credit card as well. And so you'll select whatever option you want to do. You'll see a screen like this, and the reason for the payment, you'll see a big long list here. But again, if you just want to make those quarterly payments, you're going to do estimated tax and then make sure that the tax year is applying for where you want to. Sometimes there's a period here where you can make payments for different years. And so you just want to make sure that you are uh, paying taxes for the year that you're intending. And then there's going to be a couple screens on just identity verification and entering your personal information. The first one that you'll see is an identity verification that can be a little bit confusing. What the IRS wants here is for you to select a prior year that you've paid taxes so that they can look at that tax return and then match up your personal data to that. And this is so if you have a common name, if your name's John Smith, for example, they want to make sure they're applying this payment to the right John Smith. And so they're going to say, find a prior year, look at your social security number, your date of birth, and make sure that the right John Smith is getting credited here. And then again, very straightforward. How much do you want to pay? What's your bank account number? And the IRS will pull it directly from there and make it very easy. Doing online payments tends to just be the easiest way anymore. You can, of course, send a check-in. Also, online payments gives you a lot of confirmation, right? The IRS isn't going to lose your check in the mail or it's going to sit on a desk and not get cashed for a long time. And then you also get this online portal where you can go in and see payments that you've made. So come tax time, when you want to tell your CPA what taxes you've paid in during the year, if you pay online, you also get kind of a nice way to track what you've done. And then, of course, like I said, besides the bank account, there's a credit card option available as well. There's added fees for this. You'll see a percent-based fee. And so for some, this can be kind of an added fee they don't want to pay. Sometimes this can be advantageous if you have, credit card with a no interest period. You get good rewards for your credit card, something like that. Sometimes if you're just in a bind and need a little extra time to get some cash, it might be worth it. It's a popular way taxes are paid. Whether or not you really want to deal with that added fee and justifying that's kind of up to you, but you should know it's an option that's available. So I hope that was helpful. Just a quick kind of overview of estimated taxes, what the IRS is thinking as they're looking through your tax return, and some ways that you can reduce that underpayment penalty if you've been subject to it in the past. So of course, if you have questions, let us know. This is always just a very individual type of topic. Nobody's two tax returns are the same. And so if you have questions, let us know. And of course, this is something that as we do your tax reviews here in the spring, we're looking at with you. So, of course, know that we'll bring this up if we see a problem with your return. But if there are no questions, thanks so much. Have a great weekend and take care. Bye-bye.